Hey everybody, Kimosabi here. A little follow-up to our anatomy of a crash scenario. I have the Dow Jones here, and I've been comparing the 1 week from back in 1929 from the peak um, before the Great Depression started, and comparing it to the 2 week chart of current price action. Things are kind of matching up pretty nicely um, with a 1 week to 2 week comparison. From the all-time high from 1929, you had 5 weeks of downside. One, two, three, four, five. And currently, from that pivot high, you had one, two, three, four, five, down to a low on the 2 week chart. Back in 1929, you had a bounce for. Did that gap up? That must have gapped up and then swung fail the high and then started crashing. So this had a very nice buyback as well. You're looking to swing fail right there. This is looking like it's matching up very nicely. Let's take a Fibonacci retrace from 1929. You barely made a 618 retrace, if that. And let's check on current price action. See the retrace from pivot high to the low. It's exactly the same. Barely making up 618. Like, didn't even touch it. Same thing in 1929, didn't even touch it. Kind of looking eerily similar. And in 1929, after that 618 retrace, if we zoom out, we had 50% decline from the all-time high. If you were to have similar price action, you would be pivoting this week, likely closing this 2 week candle, which closes in 2 days from now, closing that red, and then you would measure down like 50% from that pivot high. Let's see how far down that'll take you. 50% takes you to 22,000 on the Dow Jones. Given inflation and uh, how much the currency is devalued, I don't know that that's proper target. It seems very ambitious to make it down, basically down to the COVID lows. Yeah, it would take back all of the rally that happened in the past 4 years. Not impossible. Seems like an ambitious target, though. If we're to just look at the current price action, we had a very nice monthly buyback candle. Even the 2 week chart looks good. We're getting buying happening on these wicks down here. So that would tell me that you do have buying interest there, but who's buying? Is this just a dead cat bounce? I think you can manage risk off of that if you want to go long in this market, seeing as you took out all this liquidity from 2024, like the entire rally, all through 2024, you now have taken out that liquidity. So if you were to break below that wick low, the market is likely targeting lower liquidity. I would say you could maybe wick it and then rebound sharply. That would look a lot better. But if you break below, have a little bounce, and then break it again, I'd be more in the 70 to 80% confident that we're going to go visit these lows at 30,000, and potentially you could get some real panic in the market and have something, maybe not 50%, but maybe taking out the 2022 lows. I think that would get enough panic. But you never know. Once a market starts moving in one direction, the herd jumps on, it can go further and faster than you would expect. So if you were to have a similar price action to 1929 with a 50% decline that comes down there. If you were to get that type of price action that takes out the 2022 lows, I would be willing to bet that's when the money printer would start in earnest. You'd be getting Fed pivoting, interest rates lowering, and fiscal stimulus, whatever, to try to bring back confidence in the market. But it's possible that that doesn't do anything, that it just boosts inflation and it actually does not go into these capital markets, and you end up having a weak bounce similar to that into an economic downturn. It may last for quite a while, and that would implement change. I mean, you got to think it's been 100 years since something like that's happened, and if they are going to implement change, bringing AI systems online, changing the way that business is done, these things tend to get rebuilt after things are destroyed. Similar to the dot-com bubble. You had the dot-com bubble, all about the internet, emails, and everything was going to be explosive growth from there. And what do they do first? First, they destroy it and then rebuild it to be able to accommodate that. I wouldn't even necessarily say that it's like a crash to let the big boys in to get their allocation. I don't think they really care about such things like that. If you think even bigger than that, you have to think that the infrastructure being built for such things is getting done now. They're not even ready to start capitalizing on that. If you think about Facebook and like Mark Zuckerberg, they were building data centers to accommodate this AI surge. They started back in 2018. And since 2018, we've had a very nice crash. We've had a rally, we've had a crash. And now everybody's talking about the AI, and those data centers are getting used. And that was 6 years ago, 7 years ago, that they broke ground on those data centers. So whatever the future is that they're going to be bringing into play, the investment or breaking ground on the construction of whatever it is may not have even started yet. So building the infrastructure to bring us into whatever system is going to be brought after this cycle ends, it may take some time, and this is how it would be done. And it always contingent, of course, of breaking that low that we just had back in April. So let's start drawing this out. If you were to break that low in April and come down, taking out the lows of 2022 and get into the wick of the COVID lows, and then the money printer starts kind of to mimic this pattern. This could be where money printer is coming in, and that could take all the way into almost midway through 2026 that you would have this dead cat bounce. And you think a 50% decline or 40% decline, that would appear as though that's a bottom. It has a similar decline to 2008. I think we're good. Money printer is here. I think we see new all-time highs coming. Whereas maybe the economy is too damaged at that point and you have layoffs and stuff, and then you end up getting this real economic decline and totally destroy our current system to rebuild whatever it is they want to bring in. Now, this is just a wild speculation, but if the patterns do match, that would make sense that somewhere in this region, like while the money printer is going, you're likely to have outperformance in gold and potentially Bitcoin as well. They may retain their value. They may hold up better. And if they do hold up better on any bounce, they're probably going to break new all-time highs again and again. That's what the money printer does. That would be the basically everything aligning for hard assets in that region. However, the money printing that governments do ends up being a devaluation of currency and an oversupply of treasuries and or government bonds. This may be what breaks the current debt markets or the bond market, which tightens up credit so bad that you do have this economic decline. That is kind of the story that this is painting for me. If those scenarios play out in a summary, there you would have your stock markets kind of crashing or looking like a very nasty crash into big money printing, fiscal stimulus, and hard assets getting more and more expensive, potential inflation as well. But that fiscal stimulus destroys your bond market. Nobody trusts the bond market anymore. And once that happens, credit dries up so bad that you do have quite an economic decline. And maybe that's the system that is breaking, and the new system that is brought in is not one of sovereign debt. It could be one that is backed by gold or backed by Bitcoin or a combination of the two of some sort, or commodities in general. You could back your currency with oil, like Venezuela tried to do. So might be a race in the next year or two to gather as many hard assets as you can in order to deploy them whenever these index funds end up bottoming out, potentially way lower sometime 2028, 2029 maybe. Depends on how long they want to stretch this thing out for. But wildly speculative, but it's definitely something that's on the radar. It's something that I've been anticipating for years now. Not making this a call saying that's definitely the top and we're definitely going down. What I'm offering here is a setup. It's a trade setup. It's a trade idea with clear invalidation of current all-time highs. That would be your stop loss, and expect lower into some type of bear flag, and then very slow down downtrend. But certainly one step at a time. Nothing is guaranteed yet. Right now, we do have a lower low, like a weekly close lower low. Next step would be to get a lower high, then another lower low. Then you're in a downtrend. If this closes a higher high, then it's certainly out of the question. That's no longer the base case, and you'd expect continued up markets. And the currency gets devalued sooner than I would expect. But everything's on the table at all time. It's just something that I'm contemplating is fairly imminent if it is going to happen. Maybe starting this week into summertime. Things are on a cliff that it's not shaping up nicely. Just mimicking this pattern. It's all looking like it's lined up, engineered this way. So that's my rant. Keep them stops tight and have a good night.